Hello, I'm Laura McHarrie at The Hidden Edge with another tea break tip on how to use business models and tools to help you manage your growing business. Today, we're looking at the return on capital employed. This is a really useful set of ratios to help you with the assessment of capital investment projects. In the three examples I'm going to show you, I've used the most simplest of versions. It may be that you have already used versions to identify whether you're making a profit on the money invested, in which case you may want to take the calculations that one step further. However, to get us started, it's important to understand how they work. There are three principal methods for evaluating whether a capital project is of value to your enterprise. The first is the accounting rate of return, or the return on investment. This method calculates the profits that will be earned by a project and expresses this as a percentage of the capital invested in the project. The higher the rate of return, the higher a project is ranked. This method is based on accounting results rather than cash flows. The payback period. This method of investment appraisal calculates the length of time a project will take to recoup the initial investment. In other words, how long a project will take to pay for itself. The method is based on cash flows. The net present value. This method considers all the relevant cash flows associated with a project over its life and adjusts those occurring in future years to their present value by discounting at a rate called the cost of capital. The net present value method should be used wherever possible, since it is consistent with the objective of maximising shareholder wealth. The reason the three are actually in a Venn diagram is because you can use each individually. But if you use a combination of all three, you're much more likely to get a real good view of what it is that you are going to get from the money that you're investing. So moving on now to the accounting rate of return. What does that look like? A capital investment project may be assessed by calculating the return on investment, or the accounting rate of return, and comparing it with a predetermined target level. A formula for accounting rate of return, which is common in practice, is the estimated profits divided by the investment multiplied by 100 to give you a percentage. So in this example, the estimated profits that we're going to get from the £8,000 investment in the project is going to work out at 125%. So in other words, we'll get 25% more than what we have invested in. The advantages of this is that it's a widely understood measure of accounting profitability, and it's readily available from accounting data. The disadvantages of accounting rate of return is that it's based on accounting profits rather than cash flow, giving too much emphasis to the costs as conventionally defined, which are not necessarily relevant to project performance. And it fails to take into account the timing of cash inflows and outflows. So the payback period takes this into account. In this instance, we're looking at the additional annual income divided into the cost of investments. So our £10,000 that we're expecting to do in the first year, divided into the £8,000 that we're investing in the project, will give us a return within 9.6 months. That's 80% of a year, there or thereabouts. The payback period is a financial or capital budgeting ratio that calculates the number of days, weeks, months, or years for an investment to produce cash flows equal to the original investment cost. In other words, it's the amount of time it takes for an investment to earn enough money to pay for itself or break even. This time-based measurement is particularly important to management for analysing risk. The longer payback periods are not only more risky than shorter ones, they are also more uncertain. The longer it takes for an investment to earn its cash inflows, the more likely it is that the investment will not break even or make the profit. Since most capital expansions and investments are based on estimates and future projections, there's no real certainty as to what will happen to the income in the future. The third example was the net present value. This is the current or the present estimated value of an asset, investment, or a project based on expected future cash inflows and outflows, that is adjusted for interest rates, and the initial purchase price. Sounds a little bit complicated, doesn't it? The net present value calculation is, in this instance, cash inflows of £10,000 multiplied by 3 years, because that's what we think the life of the project is. That gives us £30,000. We minus off the cost of capital at 10% per annum. The 10% we've used as a calculation because we've borne in mind inflation and what return we might get elsewhere. So 10% is £9,090 per year. We multiply that by 3. We then take away the investments, the initial investment cost of £8,000, and that gives us a plus value, net present value of £19,270. As you can see, the net present value then means that the investment will not only pay for itself, but it will make us a significant return on the investment. The rule of thumb is that if the net present value of an investment or capital purchase is greater or equal to 0, then it's a good investment. So there you go. You've got 3 simple examples of ratios that will help you measure the return on investment. You can download the templates from the Hidden Edge website, and whilst you're there, do share your stories of how you've used investment ratios to determine the project, investing in a project or not. It's really important that you do consider what returns you will get when you're investing capital sums of money, particularly if you need to qualify that for other investors. So that's it from me. Until next tea break time, enjoy.